Hello, hello. I thought I'd give a market update last couple weeks of the year here. So what you're looking at right now is a chart of the S&P 500. You can see it's really, since the beginning of the year, it stopped going down in June. So it only went down for 6 months. And now we're trading in this range of S&P 4000, as I've said in many different videos. I know it's human nature. People attach a much more pain to the downside than the upside. So if you ask the normal person, and a lot of my clients, they assume that it's been going down since the beginning of January, where it hasn't. We are going down now, and I think we'll probably continue to go down this week. Supposedly 3,900 was some sort of major breakthrough moment that if it did break through, that it's probably not good, and it did. So we'll see. My charts show that it's going to continue to go down. This is the moving averages is what I look at. So for short-term stuff anyways, my boss indicator went back to negative. So in the short term here, that's not gonna be pretty. But again, I don't think a whole lot of more downside potential. I was going to overweight people and tiptoe back into domestic market a little bit because of the Santa Claus rally, but I decided against it because, number one, Santa Claus rally is the last couple of weeks of December. 3 out of 4 times it's higher at the end. However, if you go into December soft, like we did, that's not so true. So I decided I did want to mess with your money and do that. But I did want to also share with you my thoughts on inflation. Now, according to everything I'm looking at, inflation is officially over. So the problem with what the Fed's doing is they're looking at year over year, right? And by definition, that means 11 months, you're looking at old data. And things are moving fast here. And so really the last month is really the only relevant data point. And the last 2 months, if you annualize that over a year, our inflation's 4%, half of what it was earlier in the year. 5.1% is what the Fed wants to get to. However, the two-year Treasury, as you can see here, has come down about 50 basis points from its high, which is telling me that the bond market thinks inflation's over. And that's also telling me that the bond market thinks that the Fed will only raise rates one more time and be done. What's interesting is why, again, the bond market is signaling inflation is over is this is the 2-year. Okay, it's come down. Let's look at the 10-year. It's come down 75 basis points. And the 30-year has come down 90 basis points. That's huge. Okay, so, and again, did I just say this? The 2-year being below the Fed funds rate currently is what's signaling that inflation is over and that we're going to get one more rate hike. Very, very interesting. Not to mention, Zillow just reported the largest drop in rents in history. And oil and wheat is already back to pre-pandemic levels. So we've got to get, this war has got to get over before we can add some more certainty, I think, to the market. But the problem is the bond market is saying that inflation is over. One more rate hike. Oh, wages. That's what I wanted to say. Wages is this big deal that the Fed Powell keeps harping on. Like it sounds like until he sees unemployment go up, he is going to continue raising rates. If he does that, he will put us into a hard recession. I'm hoping that he will catch on to the fact that the labor problem that we have is a supply shock issue. Let me make sure I got that wording properly because I think I'm coming up with the wrong word. Structural shift. Sorry. The labor issue is a structural shift caused by COVID and the supply chain issues. Even the Fed Powell said in not this last talk, but the previous talk said that the labor issue that we're having is a structural shift. The Fed is not designed to deal with structural shifts. Their goal, what they're here for, is to affect aggregate demand. They're not going to do a darn thing. They're not going to be able to do a darn thing about what we're going through with the labor issue. So I'm hoping that he will catch on to that, and he will stop focusing so much on that. I think that's pretty much all I wanted to say about that. what I also wanted to say is what I think is going to happen next year. I'm guessing the first quarter or two probably going to be choppy. We got to see the earnings come through from Christmas. I think maybe the latter half of the year will be good. They may even cut rates a little bit to spur the economy, maybe. But I think I also want to. A lot of people say that there's no way that we will be able to get any kind of double-digit returns next year. And my point is, I think that that's very possible, and I'll tell you why. So if you go back 21 times that the market has had a negative year, the following year, it's very rare that the following year is also negative. In fact, 18 of those 21 negative years, 18 of them were positive the next year. And 7 of those 18, we had companies that had negative earnings, and we still saw positive stock market growth. I'll repeat that. In the previous years where we've had 21 times of negative growth, the following year, 18 times it was positive. And of those 18 times, 7 times, companies had negative earnings. So we do not even need to have positive earnings to have stock market growth. Okay, so I think that's super important, and why I think next year could be a lot better than this year. But the Fed has to get on board. Thanks, everybody.